Welcome to Finance with Factor,
Oops, apparently we're already recording, so here we go.
a place you can come to laugh and learn from local experts who love to discuss everything related to the world of real estate.
Weird passion. It's one that I actually share a little bit, so it makes me a weirdo with you.
Each week, we'll cover a unique topic
Let's talk about condos.
to help you understand the mortgage industry, navigate the home buying process, and grow your business while maintaining a slice of sanity.
Okay, fine. I've been confused by a lot of things over the past few years.
Now that he's climbed safely atop his soapbox, here's your host, Jason Factor.
So it's funny that you popped on my screen because I was just reading the email from marketing, banks versus Northpoint, kind of exactly what we're here to talk about today.
Yeah, exactly.
And the reality is it's not really one or the other because that is what our guest today does. Our guest today is Jim Leavitt. He's the head of our correspondent lending team here at Northpoint Mortgage. For those of you who are listening, thank you. My name is Jason Factor. Full disclosure, I happen to be a loan officer at Northpoint Mortgage. Northpoint Mortgage is what you would consider a direct correspondent and broker lender. We are not the only ones. Most mortgage companies in New England operate this way, or at least most successful ones do. But before we get into the meat of what all of that means and define some of those terms, I want to introduce Jim. Jim, it's so nice to see you again. It's been a long time.
Yeah, it's great to see you too, Jason. Thanks a lot. Yeah, it's been a while, but the business keeps on rolling. So here we are.
You still playing music?
Still playing music. Yep, just released a new record. So I'm excited to have that out there in the world. And
I will.
it's a good hobby.
What's the name of the record?
It's called Pelican Suite, and it's a fingerstyle guitar record with vocals, and it's a kind of a folky record. But yeah, I printed it on vinyl, so
Okay.
which was exciting for me. So
Can I download it somewhere? Can I listen to it?
yeah, absolutely. It's on Spotify, Tidal, any of those places.
I will be downloading it after that. That's what I've been listening to lately. A lot of Nathaniel Ratcliffe and
Great. Yeah.
just stuff like that.
Yeah, it keeps me sane because our business is so crazy. So
I was very disappointed that I wasn't at the Zach Brown concert and I didn't win any free
there's clues,
vacations,
right?
but
Yeah.
just missed it.
It's amazing.
But thank you for making time to do this. I know it is busy, and I do want to pick your brain on a few things. I had mentioned right off the top, banks versus correspondent lenders versus brokers. Can you, before we get into the conversation, can you just define the difference between those three types of lenders?
Sure. Yeah. So basically, I look at it as relationships. So correspondent relationship will close the loan in our name and fund the loan. And then the correspondent will in turn buy that loan from us as the originator of the loan. The broker relationships, we actually don't close in our name. The broker will close in the broker's name and the broker will fund the loan. It's sort of like a referral in a way. And then the bank and credit union, we call it specialty lending here. So it's basically special relationships I forge with banks and credit unions it's on a correspondent basis. So we still do close in our name and we sell them directly to the bank or credit union, but it's a way for them to increase their volume without having to originate the loans through their retail channels. So it's nice because we get to do some things that aren't available to everybody. It's just a special relationship that I forged so we can do things that are a little out of the ordinary and out of the box. So
I always describe it like shopping for pizza. My kids hate this analogy because they hear it far too often. But I always say you can knock on door to door and go to different pizza places. They're all making the same thing. You can go from bank to bank and try to find the perfect slice of New York style pizza. You can go to Auto Pizza in Harvard Square and get, barbecue sauce and jalapenos and pineapple, and they don't think anything of it. But if you go to the North End and ask for that, you're going to get bodily harm. And banks are kind of the same way. Like they all have their own little unique guidelines within the cookbook. And so what Jim's saying is like, you can go direct to a bank But if you're not ordering off of their menu, you're going to try to put a square peg in a round hole many times. And that's when borrowers get really frustrated. You can also go to a broker, but that's kind of like Uber Eats, where we're just the delivery service or the waiter in the situation. We're not cooking any of the food. We don't get to make any of the decisions. We don't get to make any pricing decisions, underwriting decisions, or anything else. We essentially become a client in many ways.
Yeah.
What the correspondent model allows us to do is be the personal chef. It allows us to cook the food using their cookbook, whether that's Fannie Mae, FHA, VA, or a local credit union or small bank, so that we can make the food to order to your needs. Because, I don't know, Jim, what do you want for dinner on September 13th?
Yeah. Who knows? Maybe it's a Taco Tuesday. I don't know.
So, what is the value as a lender of having a big menu that you can order from?
Yeah. What's especially, important right now is qualifying the borrower, income qualifying the borrower. And when you look at, straight Fannie or Freddie, we call it agency or government lending, they have pretty strict guidelines when it comes to that. Usually it's a 2-year average of income. You have to be, especially if it's like a self-employed borrower, you have to be on the job for at least 5 years and all that. What I've been really expanding at Northpoint is our non-QM or non-qualified mortgage section, which still is through correspondent channels. So we do have we definitely have the control over underwrite and pricing and everything, like you mentioned. But it allows us to be able to income qualify the borrower in unique ways. And so if you have a big menu, you'll be able to do more things, right? You'll be able to offer more things. And that's what non-QM has really kind of become, is this really intricate, interesting menu where we can qualify borrowers the ways you can't qualify in the Fannie Freddie world or government world. So,
Can you define QM for us?
yeah. So qualified mortgage is basically, there's a set of parameters, that you have to meet to be a qualified mortgage. And a lot of that has to do with ability to repay.
Yep.
And such.
And
That
those
was laid
guidelines have
out.
changed even within
Yeah.
the last couple of years as to how Fannie and Freddie look at income. So things like, for example, hourly pay is now considered variable. So for
Right.
someone who maybe took some time off last week or last year, and that's suddenly showing a dip in hours, that can actually impact your ability to qualify for a mortgage using the standard tools. Or it will at least impact the way we look, it can impact the way we calculate your qualified income. Because real life
Right.
income and qualified income are very different things for many people.
Exactly. Especially in this day and age, So with non-QM, there's all these different ways you can qualify. You can, if you can't get there with your regular U2 job and you might have some retirement funds in the bank, you can use those funds, what we call an asset depletion calculation. We can take those funds and divide it by 60. You don't have to set up a distribution or anything like that. It's just a way to enhance your income monthly to be able to qualify when you wouldn't be able to qualify in the Fannie Freddie world. Also, they're more lenient in debt to income, maximums. So, we have one that goes all the way up to 60 DTI, which you're never going to get an approved eligible in the agency world, right? So interesting.
What is the sort of the fear is that this sounds irresponsible. What do you mean 60 DTI? But what's the reality of it? Because realistically, some success stories, for example, I had a client once who was buying her mom or her dad's plumbing business, and unexpectedly, so long story short, she bought a house in July. Come October, her sister needs her to take on her 2 kids, and suddenly the 2-bedroom condo they bought doesn't work. Problem was, in September, she bought dad's plumbing business, and so suddenly she's self-employed with 0 history of self-employment. And
Yeah.
and we know the loan works because nothing's changed in the business, and the business has been cash positive for so many years, for 30 years. The business has been doing fine, and it's plumbing. It's not like like it's there's always the need. The business is going to be healthy. And so we were able to come up with creative solutions to be able to show using the business bank statements and business finances that she was going to be able to afford this mortgage. It wasn't a risky loan, it just didn't fit the box. Do you have a couple of stories to give some tangible examples for what you're talking about?
Yeah, I mean, a great example is debt service coverage ratio loans or DSCR loans. I mean, you qualify from the income flow on that subject property only. So if someone has no income, but they have investment properties and they want to buy another investment property, you can actually do a loan just using the income versus the monthly payment on that subject property. It's amazing.
And those have been hard in the greater Boston area just because the purchase prices are so high. But I have
Yeah.
seen them successful in certain areas, especially areas with very high Airbnb income, because a lot of those debt service loans or the DSCR loans will allow you to use short-term rental income as well.
Yeah, we run it through an engine and it spits out an annual revenue and you divide it by 12. It's very simple.
Even I can
The
do
other,
that.
yeah, exactly. And the other thing that I've noticed, another example is the self-employed borrower, like you were mentioning, if the tax returns don't show the real income sometimes on a self-employed borrower, you
Mhm.
can avoid tax returns altogether, do a bank statement loan, and we get an average monthly, income through 12 months of bank statements, 12 or 24 months of bank statements. So it's a way to show the real average. Yeah.
What about that's sort of the non-QM space, right? What about
Yeah.
an example of some of the relationships that you've forged with local credit unions and local banks? A lot of borrowers, again, to go back to the analogy of a menu or a restaurant, a lot of borrowers find themselves knocking on door to door looking for Chicago deep dish pizza, and then they
Yeah.
settle for Pizzeria Uno, which isn't,
Yeah.
that's not real.
Well, yeah.
So how does that work from a borrower standpoint? What are the advantages to working with someone and then vice versa? What are some of the advantages for that lender in partnering with us?
Yeah. So we work with a credit union that's a true portfolio lender. I mean, they only have a couple of other, like, they only buy loans from a few other correspondents. So it's only us and maybe two others they buy loans from. And what I mean by portfolio is they have a set of guidelines, but they actually allow us to write a scenario and present a scenario outside of those guidelines. And if they approve the scenario, then they will do the loan. And some of those scenarios can be pretty nutty. Income changes. If someone was like a self-employed, then they went to 1099 or something like that.
Mhm.
I've done one with 6 months of self-employed income coming from a W-2 job, and they allow the self-employed income. It's interesting, they look at the whole picture and they make a common sense decision. Are these people going to be able to repay this mortgage? So that's
And
the advantage of working so directly with them.
yeah, it's sort of. I always tell people that getting approved is it's a series of true or false questions. Do
Yeah.
you meet do you meet debt to income ratios? Do you meet credit ratios? Do you meet, there are 40 different variables that go into it. Is the place itself that you're buying within guidelines? So
Yeah.
we run through all those true or false scenarios. If they're all true, cool. Now we can price this particular product. With some of these correspondent options, what we're able to do is I can email Jim and I say, Jim, here's what I've got. Give you an example. I had one last year where we were able to say, like, here is a borrower who had a change in it, no change in income, but a change in status. She had a partnership with with another partner as a self-employed partner, and the partner left the firm. Her income stayed exactly the same. Literally nothing changed due to the structure of their business, but technically that's a whole new business because you now have a separation of partnership. And so it wasn't going to be able to go through Bank of America or even a Merrill Lynch private wealth type product. It really had to go through someone who was willing to look at the whole picture and say, you've got 99.9% trues and you have one false, I'm willing
Yes.
to make an exception. Maybe you pay a little bit more in closing costs. Sometimes the rate is actually better than the market
Yeah.
rate. So it's not necessarily always more expensive, but the structure of it is going to be a little bit different.
Yeah, absolutely. And this one credit union has, it's interesting because they will look at, I mean, we had one where it was a dentist who had been in the same line of work for a long time, decided to buy the dental practice and was basically just a W-2 employee before that. And I think he had just bought the practice and we were able to use the self-employment income. It's just, they were, if it makes sense, they'll usually do it.
And that's the
Yeah.
value of working with someone who's like, this is not self promotion, but that's the value of the loan officer, because the loan officer has to be able to know what questions to ask. If you just walk into the pizza place and say, hey, you got New York style pizza here? And they're like, sure. And they hand you a pan pizza, fine, whatever. It is
Yeah.
what it is. But if they're able to ask the right questions to get to the right solution so that they can say, sounds like what I would recommend on the menu is this, and here's how we're going to prepare that for you to accommodate for your gluten-free, nut-free, whatever allergies. Like, here's how we're going to prepare this meal to fit your needs and your appetite. And then we can pitch that to the kitchen and say, is this something that we can actually make?
Yeah, exactly. And the advantage to the credit union is that they don't have to worry about originating those loans because it costs a lot of money to originate a loan, and they have their own reasons to keep that loan in portfolio and get basically profit off servicing the loan. So that's basically why they do it.
Yeah, it's also, from my understanding, it's not only a difficult thing to be profitable on originating loans, but there's a lot of liability in
Yes.
originating loans. And so for us to be the personal chef that uses their cookbook, we're able to then turn around and say, hey, we made this one exactly the way that you would. I can't cook perfect Cajun cuisine, but if I follow Emerald's recipe, it's going to come out exactly right. As long as I do every single step exactly to the way that he tells me to do it.
Right. Yeah. Yeah, it's great. I mean, it's like I love the analogy of a menu because it really is like that. But I think you're right about the loan officer having to be able to ask the right questions and also be knowledgeable enough to know that you can go outside the box if you need to. You know,
And the boxes are, I mean, they're kind of arbitrary, right? I mean, the boxes are, so we've used the term conforming loan a few times, and I should define it. Conforming loan simply means it meets Fannie Mae and Freddie Mac's or Freddie Mac's guidelines. That's all it is.
that's it.
They are the definition of a conforming loan. In the same way that I say I'm home is wherever I'm staying that night. It could be the hotel or it could be my house or whatever. I often say I'm going home, and it's, to my parents' house when I'm staying there. Conforming simply means it fits that guideline. So those guidelines can change. Different banks have different overlays on top of those guidelines, or they might be more comfortable with different layers of risk outside of those guidelines that they're willing to take on. And again, I don't know what I'm having for dinner tonight. I don't know what I'm in the mood for, let alone 2 months from now. And so when you're out shopping for a home, you don't know what you're buying yet. It's really hard to decide if you're getting Chinese food or Mexican.
Yeah, and that brings up a good point about actual collateral, the actual property, because especially when you get to condos, is, talk about conforming and warrantable condos, right? That's definitely a box that you have to fit in for Fannie and Freddie. That's the other great thing about non-QM and specialty lending is that they'll actually entertain and do non-warrantable condos, whether it's litigation, active litigation, if there's a shared amenity fee that would put them outside of warrantability. There's lots of different ways a condo can be not warrantable. And just to have that expanded, I think that the condo that's actually going to change even be more strict soon, right? So
They are. Listen to last episode. We had a conversation actually on my last episode about The way that condo rules are changing, you're going to see a lot more unwarrantable condos coming up in the coming year. Actually, maybe even as early as this quarter. August 4th, there were some rule changes that go into effect regarding limited reviews versus full reviews. And then on January 4th, the reserve requirements go from 10 to 15%, meaning you have to have more put into reserve every month. And associations that don't follow that rule are going to get stuck and labeled unwarrantable. And so going to a restaurant that has a big menu so that you can go in and say, I'm going to order this. And then when that's not available anymore, there's still something on the menu that looks attractive is really the key to selecting a lender. A lot of people ask, like a lot of borrowers will call me and they'll say, well, I'm pricing out loans. And I say, great, price out loans. Go for it. You should absolutely shop around, but make sure you're shopping for more than just how much is the chicken parm. It's about so much more than just the price. It's about knowing that you have options and a big menu of options to pick from. And so having a teammate like Jim who can help us bring on those options and market those options to us and then massage those options once we get them in so that the investors say, yeah, that's an exception we're willing to make. Go ahead and do that loan. Now we can underwrite it and cook the food.
Exactly. And, I've been doing this since 2002. So, I've seen all sorts of stuff happen in this business, but something that's been a constant is just doing the best for our borrowers, and that's really what we do. We just make sure it makes sense and it's going to work for them. And that's basically my job, is to try to fit your scenario with a home, give it a home, so.
Well, thank you so much for joining me.
Yeah.
I look forward to getting on the road with you a bit. There are actually in particular one credit union that you and I are going to go visit and discuss because they have some creative options on their menu that we would like to be able to offer our borrowers. And I think they would probably say vice versa. I keep going back to my pizza analogy, but the idea that you can knock on 100 doors and not find the best hamburger pizza the way that you like it is, you can keep knocking on doors, or you can go to, the place where I forget what it's called over in the Peru, where Italy, where they've got all the best Italian food, and you can just like pick all from one, pick from items from different menus and mix and match as you see fit, and it's all gourmet level, 5-star level food. It's not the Sizzler, right? I'm not saying like go to the buffet and just grab stuff from the cafeteria, but you're getting a high quality product with a wide variety of options. And that's really what we're trying to offer. So, for borrowers out there, realtors out there, making sure that you're introducing people to your lenders and having them ask the right questions, not just what's your rate. It's really about what can you offer? What's on the menu? And when we need to change meals, how do we get to the right option?
That's it. You got it.
Well, thank you, Jim, for doing this. I always appreciate your
thanks,
time and
Jason.
expertise. I have a scenario I'm going to be running by you shortly, so I will call you offline.
Sounds good.
All right,
Thanks,
I'll talk to you
Jason.
soon.
Thanks for having me. See ya.
Jim.
Thank you for listening to this episode of Finance with Factor. Please remember to like, share, and subscribe. Then if you really like us, open another podcast app, Apple Podcasts, Spotify, or really wherever else you enjoy podcasts. Search Finance with Factor and do it again. The more places you like, share, and follow helps our ratings. But that can be our little secret. Have a question about today's episode or an idea for an upcoming episode? Post a comment. For more content, follow Jason Factor on YouTube, Facebook, and Instagram at Finance with Factor. All content discussed on Finance with Factor is self-published by Jason Factor, Senior Loan Officer, NMLS number 1401985. All rates, guidelines, and advice shared on this episode is subject to change. To contact Jason directly or for a full set of disclosures, visit his website at jasonfactor.com.
Jason Factor, NMLS number 140185. Northpoint Mortgage supports equal housing opportunity. NMLS number 1515. NMLS Consumer Access Star.
Go Factor!